Welcome to the weekly update. This is Being Prepared Sunday, September 4th, where we'll look at the action in the markets for the past week and then see how things look for Tuesday, September 6th through September 9th. Please be aware that the markets will be closed on Monday, September 5th in observance for Labor Day. And I hope everybody has a really nice weekend for the unofficial end of summer. So let's go back and talk about what happened this past week. For the week, the S&P fell Monday, Tuesday, and Wednesday pretty hard. We did have an up day on Thursday, but at the end of August, we ended up being down 4.2% for the month. And then things did go up a bit on Thursday, but then we came back down on Friday. So for the week, the S&P was down for the third week in a row. Friday's employment situation report, it was initially taken as positive, and it gave us a positive open, but then some news came out later on. First of all, we hit overhead resistance. In my opinion, that is what happened to the situation. And then the news was just kind of, it's significant news, but it was just used as kind of an excuse for selling to come in. That's, again, you may not agree with that, but that's kind of my take on the situation. But the Nord Stream 1 pipeline, they were going to shut it down for maintenance. They found some leaks or something, and now it's going to be shut down indefinitely, and that's kind of thrown Europe into a panic. At the same time, the G7 members got together, and they want to start implementing price caps on their exports of Russian oil, and this kind of shifted the whole positive atmosphere that we had seen earlier in Friday's session, especially on Friday, and then it shifted it more towards negative. And so then we started seeing losses after hitting resistance. Any pivot shifts, they were converted into declines. What I'm talking about is the market keeps trying to create this scenario that the Fed is going to start lowering interest rates because inflation is starting to come down. There have been two pretty significant situations in 2022 where the market started to believe that. They were waiting for a Fed pivot. That didn't happen, with the latest one happening a week ago Friday when Chair Powell was speaking in Jackson, Wyoming. Well, now it seems like anytime the market goes up, they're using that justification that, maybe inflation is coming down. Maybe there will be a pivot shift. The markets go up and the markets go down. We don't always have to attach specific reasons to it. If more people want to buy, it goes up. If more people want to sell, it goes down. So the catalyst for the declines, they really go all the way back to August 23rd when Fed Chair Powell gave his speech. Then this week, we had a little bit more Fed speak that came out where Cleveland Fed President Mester, who's a FOMC voter, made very hawkish statements, and she thinks that the Fed funds should be somewhat above 4%. That's kind of what the market's been figuring out. We were going with this 3.25% for a while, and now it's kind of going up to 4%. And she thinks it'll be that by early next year, and then she does not anticipate any rate cuts in 2023. Now, this could always change, and she is not the chairperson. So it's really what Chairperson Powell says that really matters. So the markets fear that this will slow the economic growth and lower earnings prospects, which, in a rising interest rate environment with growth really slowing down, that's going to have an impact. Interest rates, they're rising, and the US dollar continues to remain pretty strong. Then the Chinese city of Chengdu, and for those of you that don't know, I also teach English courses online to Chinese children, and I have a number of students that live in this city, and they're locked down again because they found some COVID positive tests, and so they're going to be going through and testing everybody. The reason I bring that up here is that might have some supply chain issues, that might have some economic issues for companies that do business with China. All 11 sectors finished lower for the week. And the U.S. markets, of course, will be closed on Monday for Labor Day. So for the week, we ended up being down 3.29% with the S&P, Volume, even though we had a strong up day on the 31st, that's the last trading day of the month, and September 1st, that's the first trading day of the new month, overall volume still continues to be below average. The technicals, after really looking a lot more positive in our weekly charts, they're switching back more to negative. We're full blown negative with the daily charts, with the declines that we've been seeing. And we're starting to see some more weakness coming through back into the weekly charts. And I'll go through those and show those to you. Interest rates and inflation, that's what everybody's fixated on right now. There's the whole list of geopolitical concerns. And I talked about China, oil's bouncing around, Fed speak that could be coming out, earnings that could have a real impact on the direction of the market. And then this debate going back and forth. What is a recession? Are we in one now? Or are we going to be going into one? Our trend is still weakening and it's still negative overall on the weekly chart. It's switched over to negative on the daily chart too, and is starting to get a little bit stronger. So let's go back to Monday's session where we were kind of flat on the day, but then Tuesday we saw some sell-offs. See, the interesting thing is a lot of the gaps are happening during the night. If you see from Friday to Monday, we went sideways for most of the session, but we gapped lower. So we were in the red the whole time. We did see some declines on Tuesday. Wednesday was also not a very good day. The one day that looked like things were going to be a little bit more positive was back on Thursday, where we actually ended up slightly. And then it looked like we were going to start off and really go to the races. We went up to R2 on Friday after the employment situation report came out. We just stayed right on this resistance level. And then this is when the news came out. This is when market participants said, I'm tired of waiting around for this. I'm just going to get out. And that's when we saw the real selling take place. The interesting thing about this, and one positive thing is, in the S&P, we did not exceed the low on Friday. We did not exceed the low from Thursday. And there's a trend line that we're keeping an eye on to see if we can still stay above that trend line. And I'll show you that. So for the week, the Dow was down 3%, the NASDAQ down 4.2%, the S&P down 3.3%, and the small caps here measured by the Russell 2000 are down 4.7%. Things got hit pretty hard. This is how things looked over the past week, with the Dow holding up the best. And we have the small caps and even the mid caps taking most of the brunt. And a lot of that came on Friday. This is going back to the all-time high, where the Dow still continues to hold up the best, with the NASDAQ and NASDAQ 100 really showing most of the weakness. I have to clear my throat. Sorry about that. All right, the sectors for the week, and I kind of did them in reverse order. The technology sector did the worst. That's a real growth area. Materials suffered a lot, as did real estate, where we had utilities and healthcare. They were down for the week, but not as much as some of the other sectors. And this is how we performed after the last 5 days, or over the last 5 days. All of the sectors ended up being down for just the 5 trading days last week. We do have some updates from current market valuation. I don't know why it took so long last time, but we're still in fairly valued territory according to them. Here is taking all of their charts together and combining them into one score. This is where they're coming up with fairly valued. We're above the dashed line, but we're not above the yellow line. We become overvalued when we go above the yellow line. Well, we've been coming back down lately. So looking at each individual model component, the yield curve model, it's starting to really spike up here, but it's still just below the yellow line. So it's considered to be fairly valued. The Buffett indicator, which measures stocks against GDP, they had been overextended, but they've really been coming down. And now we've actually dropped below the yellow line here. So they're fairly valued. The PE ratio, we're still seeing, depending on how you measure things, stocks are still considered to be expensive when you look at a lot of the different PE ratios out there, especially the trailing ones, which are the historical ones. But we're starting to come down, but we're still above this yellow dashed line. So when we're above that, we're considered to be overvalued. Interest rate model, because interest rates are still historically low, we're falling down here and we're considered to be fairly valued. And the margin debt, which hasn't been updated now for a while, it's considered to be fairly valued as well. We're slightly above this green one standard deviation line. And then the S&P mean reversion model, this is the one that I probably look at the most. We're considered fairly valued because we've been falling in price and we're below this yellow line currently. Sentiment, as of Friday's session, we're starting to get back into the fear area of things, but we were neutral for most of the week. And this suggests that there may be more fear that could come into the market that might suggest that maybe we're not at a bottom at this time. And here's the historical chart. This is the active asset management survey that comes out each week. It shows that when the market's going down, these folks tend to lessen the number of stocks or risky investments that they have, and this number is falling. When we really start to pay attention to this is when it drops into the 20s and even gets down to the 20 level, because these folks are emotional too. They're managers, and when it gets really excessive, we tend to use this as a contrary indicator. And when it gets excessively negative, we can also use that as a contrary indicator. Here is the latest reading from the RightX Bear Bull ratio, and we're kind of in the middle. We're not showing a lot of fear. We're not showing a lot of greed at this point. When there's a lot of fear, this will really spike up. And then we have the weekly survey from the American Association of Individual Investors. They're getting back to being extreme negative again. And so we often use this as a contrary indicator. If everybody's feeling one way, we start to look to do the opposite. But we've come down here, bounced up a little bit, come down, bounced up a little bit. Now we're back down here again. There's been a lot of false starts with this particular sentiment reading. We have the Chicago National Financial Conditions Index. We're still underneath this black line, which means things are under control. And the blue line is still showing a decline. And our spread between risky bonds and not as risky bonds, it's not really spiking up. It is going up, but it's not going up like it did in 2008 into 2009, or as it did in the COVID plunge. It is getting higher, but it's not really excessively higher right now. Here are some IsabelNet charts. This is the rule of 20, which I alluded to in last week's video, where basically you take the PE ratio and add the inflation rate to it. And if that's over 20, that means that stocks are overvalued. And here we have the red line is the rule of 20. When we get above this, that means that stocks are really either overvalued or undervalued. Well, right now, we have the blue line on top, which is the S&P, taking into account inflation, where it is above the red line. So that is considered to be that stocks are overvalued currently. Then looking forward, and that's what the stock market uses, we're starting to see revisions coming down a little bit with the forward-looking earnings per share. And that's ultimately what drives stock prices. So that's another thing to be aware of. The current forecast here for valuation, it's also suggesting, looking at 10 years, that we might see a normalized PE ratio when you compare it to annualized returns. And so this is still looking pretty positive into the future. Another thing, we're just showing cumulative flows into different assets. The dark blue line, those are stocks, that's equity. The light blue line down here at the bottom, those are corporate bonds. The orange line are government bonds, and you've got a lot of folks that are still in cash. That's the number one investment. And the dollar's held up quite well. So really, money markets have been performing okay. At least they haven't been breaking down the way other investments have in 2022. This is a little bit of a concern. The insider transactions ratio, these are legal insider transactions, where this really spiked up. And when it gets to a high reading, that's more bearish. That means that a lot of people that were going to buy have already bought. And so that may not provide some support for the market. Another thing, we're coming into a seasonally weak time of the year. Now, you can take this for what it's worth, but September tends to be kind of a weak month. And that's right where I'm circling right now. Now, sometimes we have very good Septembers. Other times we have terrible Septembers. But this is just taking the returns overall just to show how things tend to perform. And then here's the percent of large cap mutual funds that are outperforming their benchmarks. And in the course that I have posted on YouTube and Rumble, I have a section where you compare actively managed mutual funds, where they have this rock star money manager who goes out and tries to find all these great investments. How does that compare with the passive mutual funds, where everything is just on some kind of benchmark, like the S&P 500 or the Dow or the NASDAQ? Well, when the market is doing well, passive investing tends to do better because everything is going up at that point. When the market starts to run into trouble, active mutual funds tend to perform better because the managers, they jockey things around and they're able to do some plays in there to help take care of risk or even take advantage of some situations. So this is just showing how the active mutual funds out there have been really outperforming the rest of the passive mutual funds. And if you think about it, I mean, the S&P is down between 18 to 20% from the all-time high. Well, if you have folks that are jockeying things around, they will have a tendency to perform better. This is another look at the jobs, and this just is really showing us that we're not really seeing a problem yet. When we see a real decrease in temporary services, that's usually when we go into a recession. Well, this is still up in the green area here and is still holding up quite well. And that's the real thing that's causing some confusion is, yeah, we're seeing a slowdown in pretty much all of our economic reports, but employment is still really holding up. And the employment report on Friday was actually quite positive. So that's what's causing a lot of the mess right now. Here is looking at CPI, the Consumer Price Index, and this is JP Morgan's projections, and they just think that we're going to go down as far as inflation is concerned. This is another study suggesting that late September is when trouble tends to arrive. This is just showing how things in different days of the month, we've had either positive or negative returns. This should be the VIX, but the summation index is actually declining based on price and volume. I got these things a little mixed up here. This is the Ulcer Index. This measures fear, and we pretty much have been going up a little bit. We're above the moving average. That's why I say we're going up, but it has been declining, and that's kind of more in line with the more neutral reading that we're getting right now. Copper ended up being down on the week. When the economy looks better into the future, copper tends to go up, but now we've seen some recent weakness in copper. I'm not going to address the possible positive scenarios right now because as of Friday, September 2nd, they're on hold. And I do at least show you the charts in the daily videos. So if you want to keep up with those, because we're going down and everything is headed down on our charts, I'm not really addressing those right now. Let's look at some earnings. This is another indication that stocks continue to be overvalued. We have the Shiller PE ratio, which is at 29.41. The median and mean price is between 16 and 17 here. So we're still considered expensive. Now this has a tendency, or does actually look back at prices. It's not necessarily looking forward, but historically, we can still get some good information from this, and we tend to be very overvalued, even looking back. Here is some FactSet blog posts, and apparently the 2-week vacation was over. This is just a post saying that larger cuts than average to the earnings per share estimates for the S&P. This is for July and August, and it's just showing how overall they have really been lowering the earnings per share. And we have this other one. This is another chart showing this is the bottom up earnings per share, where we have price over here. This is basically the S&P, and this is the earnings per share out. And we can see how it's been actually trending lower. And that's ultimately why the S&P has been coming down. This is for the current year, 2022, and then looking out into 2023. What are they expecting the EPS to be? Well, it has been rising up and is topping out in both are starting now to roll over a bit. So that's kind of the thing we want to keep an eye on. What are the earnings per share? What are we really looking at as far as that is concerned? Here's another blog post where it says earnings insight, and this is all graphical here. About once a month or so, they come up with this kind of infographic where 404 mentions. This is the number of times that inflation was mentioned as the S&P 500 companies were doing their conference calls after releasing their earnings. This was between June 15th and August 29th. The energy sector has grown 239%. That's performed quite well of all the 11 sectors. 72 companies provided negative earnings per share guidance. This is the highest number since the last quarter of 2019. And then GAAP, this is generally accepted accounting principles versus other ways of doing accounting. You have 22 Dow companies. Those that are reporting non-GAAP earnings, the median difference between non-GAAP and GAAP was 22.9%. Not sure really what to take of that because we tend to look more at the S&P 500. And then earnings have been up 6%, but this is the lowest growth that we've seen since the last part of 2020. And the last chart here, 76% of the companies have exceeded their earnings per share estimates, but this is below the 5-year average of 77%. So we're 1% below what companies usually post for their earnings per share. All right, this is just kind of a historical look at how has the Fed funds rate probabilities been changing. August 5th, there was a 68% chance that at their next meeting on September 21st, we would be at 3 to 3.25 after that meeting. Then a week later, that dropped to 45%. Then a week later, it dropped to 41%. And then it dropped to 61%. So we've been bouncing all over the place with what they're projecting. And now we're back up to 57%. So this changes every day. And the closer we get, the more I will watch this. We still have a few weeks until the Fed actually meets, but that's a lot of the anticipation that's starting to build now. This is the Fed balance sheet. And really all we're looking at here is after it really shot up after the COVID plunge and then all the liquidity that was released into the market, the Fed balance sheet is starting to come down. Looking at breadth, we have seen a real decline based on price and volume. Our advanced decline ratio is also going more negative. The new highs and new lows continue to go negative as well. Accumulation distribution, we're still kind of on top of this moving average, but it is declining. Our trend is coming down, but the red line, they were almost getting ready to cross a few weeks back, cross positive. Things were starting to look a whole lot better, but then everything shifted after that speech was given at Jackson, Wyoming, and everything has really taken on a more negative flavor since that time. But we do have a decreasing trend overall, but it is negative. Our Arun is showing that selling has been decreasing slightly, but so is buying. So really, this is not helping us right now. The mass index, we had a recent signal. When we go below the blue line, that's signal part 1. When we go below the dash line, that's signal part 2. That tells us something could be happening. And that gave us a pretty good signal. And then we started to go up after that. Well, now we're starting to come back down. And every week that we go beyond this signal, it becomes less and less relevant. Looking at some long-term charts, the first thing I want to show you is the daily chart. This is the trend line that I'm talking about. This is just daily, where a few days before this happened, I drew a trend line from the low in June to another low that we hit. And I just thought, okay, what's going to happen here? Well, in Thursday's session, we came right down to this trend line and we held on to that in Friday's session. So this is an area that you might want to keep an eye on. Are we going to break below this trend line, or are we going to find some support and be able to go back up? You'll also notice that the 50-period moving average has been acting as overhead resistance. We had a pivot level that we hit that day, and we had a moving average that we hit that day. And then prices started to go down from that. They're blaming it on the news, but this is more of a technical picture that I'm seeing. Now I'm switching back over to the weekly charts where we showed a decline below S1 during the past week. We're below the 50-period simple moving average. That goes back roughly a year. The long-term trend is negative and showing some weakness. See how we came right up. Now, this is the 50-period moving average, which equals a 200-day moving average, because this is a weekly chart, and we came right up to that level and have been coming back down. Bullish percent index is showing some weakness. We're still above 50, but if we see more weakness, we're going to drop below, and that turns this indicator more negative. The Chaikin oscillators also showing weakness. Chaikin money flow also weakness. The force index showing weakness. McClellan oscillator is starting to show extreme weakness right here. And then here's the summation, just in case you didn't see it before. I was supposed to show the VIX chart right there, but we've just been seeing a decline overall, and this is an outdated chart. Anyway, all of our oscillators, they had been showing a lot of improvement, but they're starting to roll over now. And then the Swinland trading oscillator, we're starting to get extreme negative based on price and volume, and they are both negative. Here's a PMO study. It shows the PMO is still trying to go back up, but we have really seen a lot of recent weakness based on price and volume. The studies that we do on the PMO, we're starting to get extreme negative with those rising PMOs. We're starting to get extreme negative with the buy signals, and we're declining with the PMOs that are above zero. RSI is showing a decline and not necessarily extreme. The special K, this is a long-term oscillator that we use. It's still positive, but if we see much more weakness, this might begin to roll over as well. The stochastic RSI is starting to look more negative, as is the Williams percent R. The vortex indicator, it's still positive, but the green line is coming down and the red line is going up. So much more follow through selling, and this could switch over negative as well. The ultimate oscillator is showing weakness. The money flow is going down. The Bollinger Bands percent B measurement, that is also showing a decline. The KST, this is a longer term oscillator too. It did turn up, and it's not really picking up the decline yet, but if this continues, we could see this start to roll over also. The PPO, also, we don't get a lot of signals from this indicator. We did get one at just a good time, but then we went all the way up to here, it stalled out, and now we're coming back down. If we see some more weakness, the PPO may continue to show weakness. Rate of change going back 1 week actually advanced slightly. The rate of change going back 50 weeks showed a decline. The Copic curve, we also had a signal that was generated when we hit the June lows, and then we saw a nice little run up out of that. Is that signal now being negated? Because now we're starting to come back down with price. We're still okay as far as our weekly fib chart. We haven't really come down to other levels yet, but if we see follow through weakness, we might come down and test some previous lows. Our different charts, the Heikin Ashi is negative with the black bar there. The Kegi is still positive. When it's black, it's positive, but it's going down, so it's starting to show some weakness. The Renko is still positive with an open box, and the ease of movement is showing that it's pretty much flat going back 1 week, but going back 14 weeks, we're starting to see weakness. We saw some new red zeros drawn in here with the point and figure chart, and this is a high pole warning that was generated on August 29th. This could be more negative. And the three-line break, this is still positive. It hasn't picked up a lot of the declines yet, but if we see more follow-through selling, this chart may turn negative. Our Elder Impulse system for the last 2 weeks has gone back to negative. Our SAR, it continues to be positive. So we're getting some mixed signals here. Looking at the broad market, this is just a plain vanilla look at the S&P, the mid caps, and the small caps, and they pretty much, we're not seeing any real big divergences, either positive or negative. All stocks, after really trying to come back, have now shown weakness. The mid caps also showing weakness, and this is going to be the same thing. Small caps, after really bouncing nicely, have shown weakness. The Dow showing recent weakness. The NASDAQ, weakness. NASDAQ 100, weakness. NYSE, recent weakness. Wilshire 5000, weakness. The FANG stocks, weakness. ARC, weakness. My gosh. The biggest software companies in the US, after having a nice little bounce, have seen recent weakness over the past few weeks. This is Dow theory, looking at how the Dow has been declining, as have the transports, and the utilities have been holding up a little bit better, but they've also seen some recent weakness. The CRB index, it still is in an overall uptrend on the weekly chart, but we're below the 13 period moving average. Gold continues to really struggle, as does silver. Oil, we're under 90 right now. We're currently at 86.87. And here's the dollar. It continues to just shoot to the moon, especially when you compare it to the euro and the Japanese yen. Looking at bonds and interest rates, we're not seeing a follow through with price based on the bond ETF here, and that's really starting to break back down. Yields, they were really going up, even though this is a daily chart. They did come down in Friday's session. Looking at some relative studies where oil has been doing the best, followed by the dollar, where gold, stocks, and bonds are negative going back to the beginning of the year. The bond to stock ratio still is starting to underperform, even though it came up a little bit this past week. Looking at a monthly chart, stocks continue to outperform bonds. This is gold to the US dollar. Gold has been really having trouble while the dollar's been going up. So that's why we're seeing this ratio going down. And gold to the S&P, gold had been really suffering, but since the S&P has hit some problems, it's actually outperforming. Gold is actually outperforming now. Low volatility stocks, they had been doing quite well, falling back. Well, as prices continue to fall, this ratio continues to show some improvement. Growth versus value, we're still showing that growth is in an overall downtrend. It had been trying to make a comeback, but is showing some recent weakness. NASDAQ 100, mostly growth to the S&P 500, shows that the NASDAQ 100 is really underperforming. And the S&P 100 is also underperforming the S&P 500. Discretionary is also continuing to underperform staples. And the energy sector, after showing some weakness, is now starting to outperform the tech sector. So what's our outlook for the upcoming week? On Tuesday, we have the ISM non-manufacturing. That's a big report. We had the manufacturing report on Friday. On Tuesday, we're going to get this one. Then really the next big one is jobless claims on Thursday. And those are kind of the big reports. There's some other ones that will be released, but they're not all that big a deal. Our technicals, they're really showing a lot of weakness right now. There's a few areas of positive things. Our daily charts are looking quite negative right now. The markets are really fixated on this inflation and interest rate scenario. There's a whole list of geopolitical concerns. We have China in the mix with their supply chain and their lockdowns. Oil's bouncing all over the place. You have Fed speak that might come out. Earnings are being released. And I'm not really addressing Japan right now. I'm watching that. And when that becomes more of an issue, I will address that more. So what are our scenarios? We have to go with the down scenario. Now, this is based just looking at Tuesday's session from the daily charts. Because of all the things that I just mentioned here, all of these headwinds, that's really difficult for the market to fight against these things. And our technicals are negative, but we're still watching that trend line. And at least on a short-term basis, on the daily charts, we are oversold. So we can't really go with a positive scenario now because the technicals are so negative. And will we get some kind of a bounce from that trend line? Now, if we break through that, that's going to just add more things up to the negative side. But if we get some support and bounce up from that, we'll want to keep an eye on that and see if we can see some follow through buying. Our scenarios, the rotation, our setups, those are all on hold right now. And our technicals are pretty much negative, so we can't really look at those. We're losing a lot of the moving averages that we had recaptured, and it's just not a really good looking market right now. And we're not going sideways because on the daily chart, the ADX is above 20 and the red line's on top, so we're negative overall. So thank you. I hope you found some use from this. I will be posting the intermarket analysis video as soon as I get that prepared and ready to go. Have a great week, and I'll talk to you next week.